Hi class, in this video we're going to do some of the brief exercises for chapter 7. So we'll start here with 7.1. So cash and cash equivalents. So it says the following footnote appeared in a recent financial statement of the Coca-Cola company. It says we classify time deposits and other investments that are highly liquid and have maturities of 3 months or less at the date of purchase as cash equivalents. We manage our exposure to counterparty credit risk through specific minimum credit standards, diversification of counterparties, and procedures to monitor our credit risk concentrations. So for A, it's asking, are the company's cash equivalents debt or equity securities, and how do you know? So cash equivalents are usually going to be short-term debt securities like treasury bills or high-grade commercial paper. So to qualify as a cash equivalent, a debt security needs to mature within 90 days or less, be very safe, and have stable market value. So to meet those characteristics, those standards for being a cash equivalent, only a debt security that matures within 90 days would qualify. So equity securities don't have any maturity date, so it wouldn't qualify as a cash equivalent, and many equity securities wouldn't be considered very safe. So we can assume that those cash equivalents that Coca-Cola is referring to are debt securities. For B, it says explain what is meant by the statement that we manage our exposure to counterparty credit risk through specific minimum credit standards, diversification of counterparties, and procedures to monitor our credit risk concentrations. So this basically means that Coca-Cola has spread any risk associated with its cash equivalents across numerous financial institutions that issue those short-term debt securities. And it's only going to invest in debt securities that meet certain minimum credit standards. So with Coca-Cola's cash equivalents, we know what something needs to be to qualify as a cash equivalent, and already needs to be very safe. But Coca-Cola is saying beyond that, they're spreading any risk associated with investing in these cash equivalents by spreading that risk amongst many different types of those debt securities. So that way, it's like diversifying your portfolio, right? But here we're specifically talking about cash equivalents. So spreading that risk by investing in all different kinds of debt securities that qualify as cash equivalents. Okay, so let's move on to 7.2, bank reconciliation and cash equivalents. So we're going to be given a chunk of information here, and we have to reconcile our bank balance with our book balance. So it says the cash account of LICO Corporation showed a balance of $21,749 at December 31st prior to preparing a bank reconciliation. The company's bank statement showed a balance of $22,000 at the same date. So we can see the cash balance according to our cash account and our bank statement balance aren't in agreement. So it says the only reconciling items consist of 1, a $5,000 deposit in transit, 2, a bank service charge of $200, 3, outstanding checks totaling $9,000, 4, a $3,000 check marked NSF from Suskew Company, one of LICO's customers, and 5, a check written for office supplies in the amount of $1,832 that was incorrectly recorded by the company's bookkeeper as an increase in office supplies of $1,283 and a reduction in cash of $1,283. So a little transposition of numbers there. In addition to this information, LICO owned the following financial assets at December 31st. 1, a money market account of $60,000, 2, $3,000 of high-grade 120-day commercial paper, and 3, $5,000 of highly liquid stock investments. So that little extra bit there that they tell us of its financial assets, we can ignore that for the purpose of the bank reconciliation. So that's what we want to do first. So for A, it's asking us to do the bank reconciliation first. Okay, so we want to, because at the end of the day, what you think you have in your cash account or in your checking account according to your cash account on the books, that needs to, at the end of the day, or at least at the end of each month, agree with what is in your bank account, right? But sometimes due to timing differences, mistakes on either end, but mostly timing differences, we see that these two numbers don't agree, because the bank statement is the bank's last record of what we have in our checking account, right? And if we look at the cash account now, that's our last record of what we have in our cash account, right? So if there's a timing difference, something hasn't been recorded yet or correctly, or something happens, then those two amounts might not agree with one another, but they should. So that's what this bank reconciliation is for. So with this one, we're going to go ahead and start with, well, we'll label this bank reconciliation. And this is not a financial statement or anything like that. This is just a document that a company will do at the end of every month to reconcile those two amounts. Okay, so this bank reconciliation for LICO. So we'll start with the balance per the bank. Now you technically can start with the balance per the books, but I'm going to start with balance per the bank. So according to the most recent bank statement, our cash balance is $22,000 in our checking account, right? So now the first thing you want to do is you would want to add anything if there's anything to add, and then we do any subtraction. So the first thing we want to do is there anything we need to add to the balance per the bank? So we want to look at this list and ask ourselves, well, is there anything that the bank isn't aware of yet that will cause our checking account balance to increase? Is there anything that the bank isn't quite yet aware of? Well, if we look at that first reconciling item, it says a $5,000 deposit in transit exists. So what does that mean? Simply that means some checks or a check was deposited at the bank after hours, like in the night deposit box or chute. So anytime there's a check or checks deposited after hours, the company itself knows about that deposit, right, and can go do the journal entry to increase cash already. But the bank itself doesn't yet know, right? The bank won't know until they receive the check and that deposit clears. So this $22,000 on our bank statement doesn't yet reflect the fact that we just deposited some cash, right? So here we'll just go ahead and add deposit in transit. So add that $5,000, because give it a day or two, a couple of days, depending on when that deposit was made, that $5,000 will eventually show up in our account, right? So that's just a matter of time. Now, is there anything else here that we need to add on the bank side of things? I don't see anything else that needs to be added, okay? But just make sure you go through everything and make sure there's nothing else that needs to be added. So if you have finished all the additions, then you can do all the subtraction. So we'll do less or deduct. So is there anything here that the bank isn't yet aware of regarding a decrease in the cash balance? Well, if you look at number 2, a bank service charge of $200, the bank knows that they've charged us $200, right? So that doesn't need to be adjusted on the bank's side, right? What about outstanding checks totaling $9,000? That would work. Because what are outstanding checks? Well, just like a deposit in transit, an outstanding check, outstanding checks refer to checks we've written to other parties, but they just haven't cashed those checks or those checks haven't yet cleared the bank. So when you write a check to pay for something, like you're paying your utility bill or you're paying your accountant, when you give that check, obviously the company treats checks as cash, right? So as soon as you write that check, you're treating it as if you just reduced cash, although it hasn't been taken out of our account yet. So as soon as we write the checks, we'll do that journal entry and reduce cash and all of that. So we can assume that's been done. But on the bank's end, if the bank hasn't yet if the checks haven't yet cleared the bank doesn't yet know that our cash balance is going to fall by $9,000, right? So that $22,000 here doesn't yet reflect that reduction in cash of $9,000. So here we're going to have to subtract on the bank side of things outstanding checks. So we'll subtract $9,000. we'll just want to check, is there anything else? So other thing there was a NSF check, $3,000 check marked NSF. Anytime that's another way of saying a check has bounced, right? Well, when a check bounces, the bank knows, right? So we don't have to adjust that on the bank's end. They're the ones that know first. And it says we wrote a check for an amount of $1,832, but we recorded it incorrectly on our books. So that's not something we need to adjust on the bank's end. So that's pretty much it for the bank side of things. So let's do 22,000 plus 5,000 minus 9,000. When we do that math, we get $18,000. And this $18,000 that we just found, that would be our adjusted cash balance. So if we've done this part correctly so far, that's the number we're striving for. Now when we do the second half, that's what we want to we're hoping it equals. Now that we've adjusted the balance per the bank, next we're going to adjust the balance per the books. Now another way you'll see this, instead of balance per books, sometimes in Connect you'll see it as balance per depositor's record. So that's also a way you'll see it. So balance according to our books, it says the cash account of LICO Corporation showed a balance of $21,749 at the end of December. Now we'll do any additions if applicable, any deductions if applicable. So we dealt with number one, and we have a bank service charge. So a bank service charge of $200, that's on the bank statement, right? The bank knows that they've charged us $200, but we just haven't yet recorded that, right? We don't know, we were just receiving the bank statement and seeing this charge from the bank. So that's something we need to adjust on our end, but that's a deduction, right? We just dealt with number three. Number four, a check bounced. So the bank service charge we know is a minus, right? But with number four, a $3,000 check marked NSF from one of LICO's customers, what's happening there? Well, we said that's a check bounce. So this company, Suskew company, wrote us a check in payment of what they owe us, and we took that check. So what happens when you initially take a check from a customer as payment? How do we regard that? We treat it as we just received some cash. So when we received that $3,000 check, we went ahead and debited cash and credited accounts receivable. Okay? So what ended up happening a bit later is we made that entry, but that check bounced and we actually never received the cash. So we recorded an increase to cash of $3,000, but that never happened. So we need to make that adjustment, right? That's also a minus because we need to now show that, okay, that $21,749 includes an increase of $3,000, but that never happened. So we need to make sure to take that out. So that's, along with the bank service charge, that's also a deduction. And what about number five? It says we wrote a check for $1,832 when we bought some office supplies, but the bookkeeper on accident debited office supplies not for $1,832 but for $1,283 and reduced cash by $1,283. So we didn't reduce cash enough, right? So we're going to have to reduce cash a little bit more to show that we actually paid $1,832 for the office supplies, not just $1,283. So that's another deduction. So there is, if those are all deductions, I don't see any additions in this case for this problem to the balance per the books. So there's no add category, there's just going to be a less category. It would be an example of an addition to the balance per books. That would be if the bank collected an accounts receivable on your behalf. If a customer went and paid off their balance, and then you see that on your bank statement, then you would go ahead and that would qualify as an addition. But there's only subtractions here. So the first one is a bank service charge. So we don't know yet, but we paid $200 in bank service charges, right? So we didn't know that yet, but now seeing the statement, we see that. Next is that NSF check, where we thought we got $3,000 earlier, but that never happened, so we need to take that out of our cash balance. So that's accurately reflected. And let's take a look at the book error. So we wrote a check for $1,832, so we paid the correct amount, but when we recorded that payment for office supplies, we accidentally recorded the reduction in cash as $1,283. So we didn't reduce cash enough, right? Cash was reduced by $549 too little, or too, that's the amount that's missing, right? So we need to, as a result of this book error, subtract $549 from our cash balance to show that we actually spent $549 more than we recorded we did. Okay, so that's it. So that's the balance per the books minus these subtractions. We can take that $21,749 minus the $200 bank charge minus the $3,000 check that bounced minus the $549 that we should have further taken out of cash. So that looks like our adjusted cash balance after adjusting the book end is $18,000. So this is our adjusted cash balance. So this is what we're looking for. This tells us we've done this correctly because these two adjusted cash balances, they agree with one another. That's what we're hoping for with this bank reconciliation. That's the point, right? So really, we have $18,000 in our checking account at the bank, so our cash account should reflect $18,000. Okay, but due to timing differences and some errors and bounced checks, those numbers didn't agree when we hit the end of the month. But now, before the month closes, we'll do this reconciliation and make sure those two numbers agree with one another. Okay, so for B, it's asking us determine the amount at which cash and cash equivalents will be reported in the company's balance sheet dated December 31st. So cash and cash equivalents, so that's actually if we look on the balance sheet and you see cash and cash equivalents, that will be a combination not of just cash, but anything that qualifies as a cash equivalent. So it's the one thing we know that will be part of cash and cash equivalents. Well, our cash. And how much cash now have we found out that we actually have? $18,000. So this is our actual cash, right? But then they give us a list of their financial assets, and let's see which one of these financial assets, if any, will be included in this total instead of being listed separately as a financial asset. So what about a money market account of $60,000? That qualifies. Okay, money market accounts qualify as a cash equivalent. And what about number 2? A $3,000 high grade 120-day commercial paper. Well, didn't we say commercial paper qualifies as a cash equivalent? It does, but what's one condition that needs to be met? For any cash equivalent, it needs to be safe, right? It needs to have a relatively stable market value. But another condition for something to be a cash equivalent, it needs to mature within 90 days or less, right? Where this commercial paper matures in 120 days. So it would be listed separately. We're not going to include it in this. What about number 3? $5,000 of highly liquid stock investments. Well, liquidity is good. That means I can easily sell it, right? But do stock investments have a maturity date? They don't. And second of all, stock investments aren't considered to be safe investments if we're looking at the standard of a cash equivalent, right? So both the commercial paper and the highly liquid stock investments would be listed separately under assets and not included in cash and cash equivalents. So our cash and cash equivalents would simply be a combination of our cash balance and our money market account. So the total of cash and cash equivalents is $78,000. Okay? And then lastly, it says prepare the necessary journal entry to update the accounting records. So when you look at this bank reconciliation, I'm just going to draw a box around it, then I'll scroll down. When you look at the bank, the adjustments we made to the bank, that will sort itself out, right? The bank, the deposit and transit outstanding checks, give it a couple of days, and those will adjust themselves. Even with bank errors, most of the time the bank will identify those, especially if you're seeing it on a bank statement where it's identified. If they've identified an error, they'll go and fix that. But So there's nothing on the bank's end that we need to go journalize or do anything about. That's nothing on our end. The only thing that you'd actually have to do is if you see an error on your bank statement that the bank isn't aware of, then you obviously now have to go tell them, right? Then that would be the only active thing you'd have to do regarding that. But when it comes to the balance per the books, these adjustments we've made to the balance according to the books, it will require a journal entry or journal entries. If there was an addition or additions, that would be one entry, and then any deductions like we did here would be one entry. So we're only going to have one entry here. So we need to, currently our cash account has a $21,749 balance, and we need to adjust it down to $18,000 to what it actually is. So the journal entry for that would look as follows. Well, a bank service charge, there's probably an account called bank service charges, and this would be treated like an expense account. So we're going to debit bank service charges for $200. The NSF check, you want to ask yourself, okay, what entry did I make when I initially received the check as payment? Well, we would have debited cash and credited accounts receivable, right? But now that the check bounced, we need to reverse that entry. We need to put that money back in the accounts receivable because the customer now still owes us. We thought they paid us, but that money never came, right? So we need to put that back in accounts receivable. And then lastly, that book error, they told us what was the entry that they made when we bought the office supplies. Well, we paid $1,832 for them, but on the books we debited office supplies for $1,283 and credited cash for $1,283. So we need to repeat that entry with the amount that we missed, right? Each of those numbers should have been $549 more. So to fix that, we always have to record assets at their proper cost, right? So office supplies, to reflect that to show office supplies with a balance of $1,832, we'll debit that account for $549. Okay, and now we'll just credit cash for all of these all together. So $3,000 plus $200 plus $549, that gives us $3,749. And basically what's happening with this entry, well, in the cash account, there's $21,749 in there, and now we're crediting this account, and when we do that, our cash balance will be where it needs to be, accurately matching our bank account, our checking account. Okay, so that's it for our bank reconciliation. We'll move on to 7.3. Okay, it says Franklin Incorporated accumulates large amounts of excess cash throughout the year. It typically invests these funds in marketable securities, both short-term and long-term. The company's most recent financial statements revealed a net unrealized loss on marketable securities of $100,000. Footnotes of the financial statements disclosed that Franklin Incorporated reports its marketable securities at fair value. Okay, so that's what we need to do according to GAAP. When you have these marketable securities, this is where the cost principle doesn't apply, right? One of those situations where we're dealing with a type of asset where the cost principle doesn't apply, because according to GAAP, at the end of every year, at least, you can do it at the end of every month, but at the end of every year, you need to go and see, okay, what are my marketable securities that I still own? What are they currently worth versus what's the last balance in that account? And we need to adjust it up or down to market value. So with A, it's asking us, explain the meaning of the company's net unrealized loss on marketable securities. Okay, so there's an account called net unrealized loss or net unrealized gain, or another way we've referred to it in this chapter is unrealized holding loss or unrealized holding gain. Okay, so there's a T account, unrealized loss or unrealized gain, right? Or we combine the two. And this is basically, when you look at that balance, whether it's a loss or a gain, in this case a loss, this is going to be the amount by which the balance in marketable securities has or how much the market value of marketable securities has fallen since its last valuation. So since the last time that we made a fair value adjustment. So it's simply the amount by which the marketable securities have decreased in market value since its last valuation. Now, if this is just the first year, then it would simply just mean the amount by which the marketable securities have actually, how much their market value has dropped in comparison to their original cost. But if you've had these for a while, if we've done a couple of fair value adjustments, then it's just what is the current market value in comparison to the last balance we had in there. But since a lot of them are short term, it's accurate also to say that any unrealized loss would be the amount by which the market value has fallen in comparison to what you paid for them. An unrealized gain would be the same thing, but an increase in market value. Okay? So amount by which the marketable securities have decreased in market value since its last valuation. So this is if it's a net unrealized loss, and you just put an increase arrow there if it's a unrealized gain. How does the net unrealized loss impact the company's financial statements? Okay, so the net unrealized loss / gain, I'll just so we cover both. It's going to be shown on the income statement as a non-operating item. So you'll see it listed under the category that says other revenues and expenses. Okay, so non-operating item. So it's on the income statement, and it's part of the calculation of our net income since it's on the income statement. Okay, but more specifically, it's part of comprehensive income. We'll learn about briefly at the end. So it's part of comprehensive income. So, and it's just part of your overall net income. But it's important to note that this is on the books for book purposes. But for tax purposes, it is not part of taxable income. So you'd have to do some adjustments, some adjusting calculations when completing that tax return because of this little tidbit here. So that's on the income statement side, but on the balance sheet, this will decrease in this case, the net unrealized loss, or if it's a gain, it will increase the assets balance. Now, why is that? Well, in this case, if the market value fell, then we need to credit marketable securities and debit unrealized holding loss, right? So you actually have to write marketable securities down or up to market value. So the marketable securities account, if there's a net unrealized loss, would need to be decreased. So the balance sheet would also be affected. Okay. And we kind of already answered C. So it says, is the net unrealized loss included in the computation of the company's taxable income? And the answer is no. You can only be taxed on any realized gains, and any realized losses will affect your taxable income as well. So only realized losses / gains affect your taxable income. I'm sure some of you have heard of, capital gains, and you're taxed on capital gains in a certain way. So this is with that. So what's a realized loss or gain? That's if you actually were to sell some or all of your shares, and there would actually be a real gain or loss. But in this case, that didn't happen, so we're only referring to the change in market value of the shares we still own. So because you didn't sell them, that won't be factored into your taxable income. But it does get factored in to the net income that you actually show on your books. Okay? The rules have recently been changed. I'm not going to get into that, but previously that wasn't the case with how it's presented on the books. Previously, it would have been included under equity, any unrealized holding gain or loss, and not included on the income statement. But the rules have changed in recent years for it to be presented this way. So for D, it says evaluate fair value accounting from the perspective of the company's creditors. So they're basically asking us, well, if we didn't actually experience the gain or loss, why record it under the income statement and have it be part of net income and even comprehensive income? Well, now it's basically we're saying what's the argument for recording it this way under GAAP? Maybe what is one argument that they went for when changing the rules, right? So basically, if we do it this way, this shows how the company would be doing if the stock were sold, right? Whether it's a gain or loss, what would be their cash position? What would be their overall position as a company, their net income as a company, okay? So this shows, and I'll write this down, how the company would be doing if the stock were sold. Okay? It's basically what shows what their cash position would look like. So from a creditor's perspective, this gives them the if scenario, right? If all the stock were sold, what would the company situation look like? Would they still be liquid? Would they still be in a position to pay their debts that would be coming due? Okay, so that's one of the main reasons for including this unrealized gain or loss in the income statement in that period. Okay, now, is this actually an actual representation of how the company is really doing? We know, right? So we're assuming that the users of the financial statements, if they're not creditors, but potential investors, are informed parties. So any informed investor would then need to go, when they look at that statement of comprehensive income and the income statement, they would know, okay, this line item I see here that includes unrealized holding gains / losses, I'm going to back that out, exclude that from income to get an accurate view of how they're really doing, right? But a lay person is not going to, know to back that out necessarily if that's included in the income statement. But I guess, we can think of it as GAAP is assuming that the users of those financial statements are not lay people, but informed parties that would know to not include that in their evaluation from an investor's perspective. But from a creditor's perspective, they'd like to see that, to see really in best case, worst case scenario, how would this company be doing? Okay, so we'll move on to 7.4. Mumford Corporation invested $30,000 in marketable securities at various times during the year. On December 9th, it sold some of these investments for $10,000, and on December 18th, it sold more of these investments for $5,000. The securities sold on December 9th had cost the company $7,000, whereas securities sold on December 18th had cost the company $6,000. So now we're going to have to record something. So it says A, record the purchase of marketable securities on December 4th. Okay, so basically we bought $30,000 of marketable securities. It says at various times during the year, but we're just going to record the overall purchase of $30,000 in total on December 4th. Okay, so we'll do this on December 4th. What does that look like? Well, marketable securities is an asset, so if we bought more marketable securities, we're going to debit the marketable securities account for $30,000, and we're going to credit cash for $30,000. Okay. So something, when you're doing these calculations and these entries, it's nice to keep a T account by your side, especially when you get to the homework. So in this case, we have that debit balance of $30,000. But now for B, it says record the sale of marketable securities on December 9th. So on December 9th, it says we sold some of those securities for $10,000. Okay, so that's the cash proceeds. Okay. So cash received is $10,000. But then it says that the securities sold on December 9th had cost the company $7,000. So here we have received $10,000 for securities that cost us $7,000. So what's happening here? That's a $3,000 difference, but is that a gain or a loss from that sale of investment? That's actually a gain, right? Because we received more for the securities than what we paid for them. So to record the sale, we'll debit cash for $10,000. And we're going to credit marketable securities for the amount by which you paid for them, right? Because if I sold marketable securities, I need to credit that account, decrease that balance in that account. So in the amount by which we paid for them. So the shares that we sold for $10,000 cost us $7,000. But we need to make that balance, right? And that we actually experienced a gain. We would refer to this as a gain on sale of investment. Okay? This is what we would call a realized gain, but we're going to call it gain on sale of investment. That's the common account name. So don't choose realized gain when you journalize this in Connect. You want to use gain on sale of investment. Okay? So here, under marketable securities, I'll update that T account and just show that I'm crediting that account for $7,000. Okay? And this was December 9th. Now C, I'm going to record what happened on December 18th where I sold some more securities. So how much cash did I receive? It says on December 18th, we sold investments for more of those investments for $5,000. But what did those securities cost me? Well, it says the securities sold on December 18th had cost the company $6,000. Well, we received $5,000 for them, but they cost us $6,000. So what's happening here? That's a difference of $1,000, but that's not a gain. That's actually a loss, right? Because we received less money for something than what we paid for it. So we'll debit cash to show that we're at least getting $5,000 cash. Okay, but there's a loss here. So why did we credit that gain before? Because we treat a gain like we treat any revenue account, because it's going to go on the income statement. So gains are credited just like revenues. So losses we treat just like expenses. Losses will decrease net income like an expense does. So anytime you have any kind of loss, you'll debit that loss when it's increased. So we're going to debit loss on sale of investment. This is a realized loss of $1,000. And then we'll credit marketable securities for the cost of the securities we sold. And that's the $6,000. If we look at that T account, we further credited that account for $6,000. So after those two transactions, what's our balance in marketable securities? Well, $30,000 minus $7,000 minus $6,000, that gives us $17,000. So I'm going to move that T account down. So we have a $17,000 balance in marketable securities. Now for D, it asks us record the necessary fair value adjustment at the end of December now, assuming that the market value of the company's unsold securities was $20,000. So what's the cost of what we have left? $17,000. But GAAP says now at the end of the year, we need to say, okay, what are those shares now worth today? And on December 31st, they are worth $20,000. So we want to adjust the balance of this marketable securities account up to $20,000. So what do I need to do to this marketable securities account? I need to debit it for $3,000. But if I debit something, I need to credit something else, right? And what will be that something else that I'm gonna credit to balance that? That something else would be what we call our unrealized holding gain / loss account. So in this case, since we increase marketable securities due to the increase in market value, that's really an unrealized gain. Okay, so the journal entry for this would be a debit, and this is December 31st, end of the year. We'll debit marketable securities for $3,000 and credit the unrealized holding gain / loss account for $3,000. Okay, so that's how we do that fair value adjustment. Now, just a side note here, this unrealized holding gain or loss account now has a $3,000 credit balance as of December 31st. But what happens at the end of every year? There's some part of the accounting cycle that happens at the end of every year. And that would be our closing entries, right? We close all of our income statement accounts, all of those temporary accounts. So now what did we learn in Chapter 7? Well, the unrealized gain or loss account, that goes on the income statement, doesn't it? It's a non-operating item that goes under other revenues and expenses. It's part of the income statement. And because it's part of the income statement, it's going to get closed like all of the other accounts, all of the other revenues and expenses and gains and losses. So anything on the income statement gets closed. So before we hit January 1st, we're going to close this account to income summary like we would do any other expense. So on December 31st, let me label that here. On December 31st, that's your balance, but on that same day, you'll close it to income summary. So by the time we hit January 1st, what should you have in that account? You should have nothing. So you're going to start that new year clean. Okay, so that's it for 7.4. We'll move on to 7.6. So just a word of warning with this current edition, I have alerted the publishers, but there's a little bit weirdness here with how the text and the labels were organized here. There's a little bit of mistakes here. So for example, 7.6, all the information's given, and then the directions are given in 7.7. So just be aware of that. They haven't fixed that yet. So let's take a look at 7.6 here. It says, Patchell Corporation reports the following information pertaining to its accounts receivable. So it tells us that $60,000 of it is current, $40,000 of it is 1 to 30 days past due, and so on and so forth. So it tells us, gives us different age categories of its accounts receivable and the amount in each. And then it says the company's credit department provided the following estimates regarding the percent of accounts expected to eventually be written off from each category listed. So basically, for each of these categories, what percent of it does the company expect they will never collect? They will have to write off. Okay, so for example, the receivables that are current, only 2% they anticipate will be uncollectible. But if you go to the group that's 31 to 60 days past due, for example, they think 16% of that would be past due. If you go to the older accounts receivable that they've been waiting for over 90 days, that there's $2,000 of, they expect 90% of that to never be collectible. So as the accounts receivable gets older, the different categories of it gets older, the likelihood of not collecting it gets higher and higher. So here we're going to go to the directions. It says the company uses a balance sheet approach to estimate credit losses. So that means we're going to age this accounts receivable and figure out how much of it we will deem uncollectible. Okay, so now we'll look at A and B in a second, but let's first age this accounts receivable. So we'll do this here. So we'll do the age category. So we'll do current, 1 to 30 days past due, 31 to 60 days past due, 61 to 90, and then 90 plus days past due. And then we'll do the amount that we're referring to, the percent of it that's deemed uncollectible, and then the dollar amount that is deemed uncollectible. So how much of the accounts receivable is current? $60,000. $40,000 of the amount owed to us by clients is that's 1 to 30 days past due is $40,000. $25,000 of our accounts receivable is 31 to 60 days past due. $12,000 of it we've been waiting for 61 to 90 days past its due date, and then there's $2,000 that we've been waiting for over 90 days. So the percent of the current accounts receivable that we deem uncollectible is 2%. 4% for the accounts receivable is the 1 to 30 days past due. 16% for the ones that are 31 to 60 days past due. 40% for the debt owed to us that is 61 to 90 days past due. 40% of that will deem uncollectible. And 90% of the oldest accounts receivable we will expect never to collect. So to figure out the dollar amount that you'll never collect on, you'll just take the amount and multiply it by the percentage. So you'll just multiply each of these by the percentage. Okay, so 2% of 60,000, that's $1,200. So basically, of the accounts receivable that isn't past due yet, based on our experience, about $1,200 of that will be uncollectible. We'll have to write off sometime in the future. 4% of that we expect will be written off for the next category. 4% of 40,000, that's $1,600. 16% of the next category, $25,000, is we deem uncollectible, or we estimate uncollectible, right? So 16% of 25,000, that's $4,000. 40% of the $12,000 group, we expect will be uncollectible, so that's $4,800. And then 90% of 2,000, that's $1,800. So we're going to add all of those up to figure out what total amount is uncollectible. So if you do 1,200 plus 1,600, 4,000, 4,800, 1,800, you should get 13,400. So what's the gross amount, the total amount of accounts receivable overall? So let's add all of these total amounts up. The 60, 40, 25, 12, and 2. If we add all of those together, that's 139. So that's the gross amount of accounts receivable. That's our accounts receivable balance. But we're estimating, based on the information given, that about 13,400 of that we will have to write off at some point in the future because we're not receiving that. So we want to make that estimate now. So these accounts receivables, when did they originate? They originated in this year, right? So if any portion of it is going to be written off, we want to record that loss, that expense of being written off in this period. Although it hasn't happened yet, we're doing our best to estimate it so we can record it in this year, because we want to follow the matching principle, right? We want to match all revenues and expenses with the year in which they're applicable. So if we earned revenue in this year, we want to match any expenses that we incurred to earn that revenue in this year, right? So although these haven't no portion of these have yet been written off, we estimate that a portion of each of these will be written off in the future. So we're estimating how much will be written off so we can record that expense now. Because although we haven't written anything off, we haven't yet recorded any incurred any losses. When did these receivables originate? They originated this year. So technically, if they're going to be, a portion of them are uncollectible, they've been uncollectible from the beginning. So technically the loss has already originated in this year. So we want to record that expense now in this year and not wait until after the fact. Okay? So in this case, we want to look at what is the balance in the allowance for doubtful accounts. Well, for A, we're doing that one first. It says record the company's uncollectible accounts expense, assuming it has a $1,400 credit balance in allowance for doubtful accounts. So basically, from last year, we still have a little bit left over in this allowance for doubtful accounts from the estimate we made for last year. So there's still a credit balance left. But based on this year's estimations, we need this balance to be $13,400. So we want to top it up to $13,400, so to speak. So what do we need to credit this account for to get it to $13,400? we need to credit this account for $12,000. Well, if I'm going to credit that account for $12,000, what am I debiting? Well, that debit would be the uncollectible accounts expense that I need to record applicable to this year. So uncollectible accounts expense is, let me move that over a little bit. We'll debit that account for $12,000 and credit this allowance for doubtful accounts for $12,000. So with this balance sheet approach, when you find this estimate that's uncollectible, you're dependent on the current balance and allowance for doubtful accounts to determine what to record the expense as. And in this case, we want to top the account up to $13,400. So we're only going to record an uncollectible accounts expense of $12,000. Okay, so that was for A. But for B, they're asking us, okay, using that same information, what would that entry look like? They're asking instead if the allowance for doubtful accounts, instead of having a credit balance, actually had a debit balance of $1,600. Well, how could this ever happen? So remember, when you actually end up writing off an account later on, when you decide, okay, this accounts receivable, it's worthless, I need to write it off, then you would go and use some of that allowance, debit the allowance for doubtful accounts, and credit accounts receivable once you decide to write an account off. So when you write off an accounts receivable, you're dipping into this allowance for doubtful accounts. So it should naturally have a credit balance, but what would cause it to have a debit balance at the end of, or once you're now in the new year? Well, that just means that you wrote off more accounts receivable than you estimated you would need to. So if you credit an account for more than is there, it's gonna move into a debit balance. So in this case, we ended up using this allowance account more than we had put in there. So now we still want to get its balance to $13,400. So we're asking ourselves, okay, well, what am I going to credit this account for with that debit balance to get it to $13,400? Well, I'm going to have to credit this account for $15,000, right? Because that needs to take care of that debit balance. If I credit this account for $15,000 and there is a debit balance, that leaves me at least with that desired balance of $13,400. So if that were the case, instead the entry would be a debit to uncollectible accounts expense of $15,000 and a credit to the allowance for doubtful accounts of $15,000. And this is your initial entry. That's what it would look like under both methods, and we'll do the other method in the next problem, okay? So here, with these methods, what are you doing? You're essentially topping up this allowance for doubtful accounts. So we're estimating we're gonna write off about $13,400 of accounts receivable. And what is this allowance for doubtful accounts? It's a contra asset account. It tells us how much of the accounts receivable we're never gonna see. So on the balance sheet, in this case, you'll have accounts receivable listed at $139, right? That's how much there is. But then you have the allowance for doubtful accounts telling you, okay, of that $139, $13,400 of it we're not going to collect. So when you subtract those two, the net realizable value of that accounts receivable is only $125,600. So we're saying that's how much we expect to actually collect. Okay? But you've already recorded the expense of any possible accounts receivables to be deemed uncollectible, okay? But now, as you move into the future, let's assume that, okay, there's an accounts receivable of $2,000 now that you have to write off in the new year, right? A month later, right? Well, if you have to write off a $2,000 accounts receivable, I'm not going to record that expense again, okay? Instead, we're going to use that allowance for doubtful accounts. When that happens, then you would debit the allowance for doubtful accounts, like swiping a gift card, right? You're using some of the balance. I would debit that allowance for doubtful accounts then for that $2,000 receivable that's finally being written off, and I'd credit the accounts receivable that's being written off. Then my balance for the allowance account would fall to $11,400, and my accounts receivable balance would fall by $2,000 since it's not there anymore if I'm deeming it uncollectible, okay? So the first entry that would have to happen is topping it up at the end of the year. And then once you actually need to write off an accounts receivable, you're using that balance that you set aside. In this case, for example, if I have to write off a $2,000 accounts receivable, then I'm finally dipping into that account balance. Okay, so that's what we would call the balance sheet approach, one way under GAAP that we can estimate any credit losses and record that expense in the period in which that expense originates, although we haven't written off any accounts receivables in that given year yet. But we're anticipating it's going to happen later on. And because those accounts receivables originate now in this year, we want to record that estimated expense now, so we can align as accurately as possible with that matching principle. All right, so now we're going to move on to the next problem. So this one I think we labeled as 7.6. Like I said, the formatting, they kind of messed up the editing with this. So for example, we were on 7.6 and then it labels at 7.7, which actually refers to the next problem. So it's quite confusing. So don't rely too much on the brief exercise number. So that was technically 7.6 that we just did, and it's technically 7.7 that we're going to do now. But the problem for 7.7 doesn't actually start until here. So they just labeled it really, they messed up. All right, so we'll just assume this is 7.7. So here it says Wilson Corporation uses an income statement approach to estimate credit losses. So remember, in the previous problem, we were just using the balance sheet approach. Now we're looking at another way under GAAP that we can estimate those credit losses. It says its gross accounts receivable of $5 million at the beginning of the period had a net realizable value of $4,925,000. During the period, the company wrote off actual accounts receivable of $100,000 and collected $7,835,000 from credit customers. So credit sales for the year amounted to $9 million. Of its credit sales, 1% was estimated to eventually be uncollectible. Determine the net realizable value of the company's accounts receivable at the end of the period. And that's where the problem stops. Okay, so technically that next problem starts in that next sentence. Okay, so the first thing we want to do, let's just first determine what our entry would be to record uncollectible accounts expense. But they also give us a bunch of other information. So the gross accounts receivable, they tell us is $5 million here. So actually, we'll just deal with accounts receivable first. And it said it had a net realizable value of $4,925,000. So net realizable value of $4,925,000. So we can then assume what our allowance for doubtful accounts is, right? Because the allowance for doubtful accounts, once you subtract that from your gross amount of accounts receivable, it gives you a net realizable value. So the difference there, we can see that's $75,000, right? So that's the allowance for doubtful accounts balance prior to any changes for the year. Okay, so we have accounts receivable sitting at $5 million, and then allowance for doubtful accounts sitting at $75,000. So remember, the allowance for doubtful accounts is a contra asset account, and because it reduces our carrying value of that accounts receivable on the books. So it says during the year, the company wrote off actual accounts receivable of $100,000. So what would happen to accounts receivable when that happens? Well, that's $100,000, right? And they collected $7,835,000, $835,000 from credit customers, right? So that would also reduce your accounts receivable balance, 7,835. But remember, when you write off that accounts receivable, you're dipping into this allowance for doubtful accounts, aren't you? Okay, so we need to keep that in mind, that would affect that as well. But then it says we had credit sales of $9 million, right? So the credit sales would increase your accounts receivable by $9 million further, right? Since it's credit sales. But what we need to do is still record the uncollectible accounts expense for the year. So that'll affect our allowance for doubtful accounts. So we want to figure out what the net realizable value is of the accounts receivable. So we'll determine the allowance for doubtful accounts in a second, but let's first see what our accounts receivable is sitting at. So we have the $5 million plus minus the $100,000 minus the $7,835 plus the $9 million. So we're sitting at 6,665,000. Okay? But this problem is a little bit more involved than usually for the income statement approach. They're just giving us a bunch of extra information for us to figure out here. So the allowance for doubtful accounts, we need to top that up for the year, right? Because this year's credit sales alone is $9 million. So under the income statement approach, so this is different than the aging method under the balance sheet approach. You look at your credit sales and you take that percentage that is estimated to be uncollectible. So they say that 1% of those credit sales they estimate will eventually be uncollectible. So 1% of 9 million, what is that? That gives us $90,000. So unlike the balance sheet approach, remember we said when we determine that uncollectible accounts expense, it depends on not only what our estimated uncollectible amount is, but also depends on that beginning balance and the allowance for doubtful accounts, doesn't it? Right? So remember we had $75,000 in the allowance account to begin with. Then we credited the account for debited the account for 100 when we wrote off an accounts receivable during this year. So in this case, we'd have, what does that look like? A $25,000 debit balance, right? But under the income statement approach, I don't care what the balance is in allowance for doubtful accounts to determine what my entry amount would be. Instead, once you determine, you take the credit sales and multiply it by the percent uncollectible, that is the amount of your entry. So that just gets added into the allowance for doubtful accounts. So we're just going to credit the allowance for doubtful accounts and debit the uncollectible accounts expense directly. So we're going to debit uncollectible. Let me zoom out just a tad. There we go. I'm going to debit uncollectible accounts expense for $90,000. And I'm going to credit the allowance for doubtful accounts for $90,000. So remember before, when we did this under the aging method up above, before we determined the amount, remember for these entries up above, we first determined, we said, okay, that estimate of $13,400 is our desired ending balance, and we plugged in what we needed to get to that number, and that was our entry. But under the income statement approach, whatever you estimate uncollectible, that is your uncollectible accounts expense under this method. So this would be our entry to record uncollectible accounts expense for the period. Okay, so in this case, our allowance for doubtful accounts would have changed. So let's see what we have left. So we have the $75,000 minus the $100,000 plus the $90,000. So that leaves us with a $65,000 credit balance in the allowance for doubtful accounts, right? So here, where we had already updated the accounts receivable to know what we'd be left with for accounts receivable, now we can do that for the allowance for doubtful accounts, the beginning balance minus what you used throughout the year. But now we're topping it up for this year, right? And we topped it up in the amount of $90,000. When we do that, we are left with $65,000 in that balance. Now the question is asking us, what's the net realizable value of the accounts receivable? So remember, under the balance sheet, under assets, you'd have accounts receivable listed there at its gross amount, which we found to be $6,065,000. And now the allowance for doubtful accounts has been topped up for this year's credit sales, and that it has a balance of $65,000. So our the accounts receivable net realizable value is $6 million here. Okay? So that is how we determine net realizable value. But the most important takeaway here is how to determine the amount, the dollars uncollectible, we estimate to be uncollectible, and then what that entry looks like. Because the entry itself looks like this. You debit uncollectible accounts expense, and you credit allowance for doubtful accounts. The entry, the structure of the entry looks the same under both methods. The difference is the number you use in that entry. In the balance sheet approach, you're dependent on the beginning balance and allowance for doubtful accounts, but in the income statement approach, you don't care what is in there to begin with. You just throw in the amount that you estimated for this period. Okay, so those are the two GAAP methods. But I'll just make one quick mention of the other method that is non-GAAP. It's the direct write-off method. The direct write-off method is only GAAP approved if the company has an immaterial amount of accounts receivable at any given time. So if the company isn't used to having a lot of accounts receivable and it's not material in amount, then the direct write-off method would work. But if it's in any way material, then they have to use one of the two methods we mentioned now before. With this one, there is no allowance for doubtful accounts used. There's no effort here to follow along with the matching principle. Instead, when you figure out an accounts receivable is uncollectible, instead, at that moment in time, so let's say this year you decide, let's assume we're looking at that $100,000 that they wrote off here. Instead of using the allowance for doubtful accounts, debiting allowance for doubtful accounts and crediting accounts receivable, instead you would then, at that point, under the direct write-off method, debit uncollectible accounts expense, let's assume for $100,000, and credit that accounts receivable for $100,000. And regardless of when that accounts receivable originated, it could be, 3 years old, right? But under the direct write-off method, when we decide to write something off is when we record that expense. So although that accounts receivable might be 3 years old, when are we recording that expense? 3 years later, right? So there's no effective matching here. That expense is really from 3 years ago that you're now recording now in this period and matching it with revenues of this period. So it doesn't do a good job at all with matching expenses to revenues. But when would this make sense? When you don't have a material amount of receivables ever. If your accounts receivable balance is always really immaterial in relationship to everything else. So then the direct write-off method would work. Then you're saving yourself time, right? Cost-benefit analysis. If I have a really small amount of accounts receivable and I have to write some of them off once in a while, then this method would make a lot more sense. It's going to be a lot more effort to do it the other way. It wouldn't make sense to do it in one of the other two methods, right? But we have to realize that it does no job at all of matching expenses to revenues effectively at all. You could be recording expenses in a period where those expenses actually originated many accounting periods ago. Okay, so I just wanted to mention the direct write-off method, that is that third method, but it's only allowed under certain circumstances. Okay, but this one above was the income statement approach. All right, and we'll move on to the next one. So again, this next problem, I think we would label this as 7.7, the one we just did. So technically it's 7.8 now. And this one's starting here. So it says, following are the average accounts receivable and net sales reported recently by two large beverage companies. So we have Molson Coors Brewing Company and Anheuser-Busch. They give us the average accounts receivable for both and the net sales for both. So for A, it's asking us compute the accounts receivable turnover rate for each company and round your results to one decimal place. So we have Molson and then we have Anheuser. Okay, so what we'll do is for each of them, we'll do accounts receivable turnover. So accounts receivable turnover, how do we calculate that again? So that is going to be your net sales divided by your average accounts receivable. Okay, so net sales divided by your average accounts receivable. Now here they give you the average accounts receivable. If you don't have the average, you either use the ending accounts receivable balance or find the average yourself if you're given both the beginning and ending balance. So the net sales for Molson is $11,003 million, but we're going to keep them without all those extra zeros, so that's in millions. And the average accounts receivable is $691 million. Net sales for Anheuser, $56,444 million. We're going to divide that by its average accounts receivable of $6,459 million. So let's find the turnover for Molson first. It's basically looking at how quickly they're collecting their accounts receivable, right? So that's about 15.92 times. And then for Anheuser, we'll do 56,444 divided by 64.59. That's about 8.73 times. So basically, Molson is collecting its receivables in full about 15.92 times a year, where Anheuser is doing that about 8.73 times a year. Now, they want to know on B, compute the average number of days it takes for each company to collect its accounts receivable. So that's where we're going to take these turnovers. Instead of looking at it how many times a year this is happening, look at how many days on average it takes them to collect any given accounts receivable. So how do we do that? We take the number of days in a year, 365, and divide it by that turnover rate. We'll convert it into days. So for Molson, we can round that to about 23 days. And for Anheuser, we'll round that to about 42 days. So for Molson, they wait about 23 days to collect their accounts receivable, any given accounts receivable, and Anheuser, they wait about 42 days to collect their accounts receivable. So C, it's asking, based upon your computations in A and B, which company's accounts receivable appear most liquid? Well, for both of them, it's a relatively short period of time, so both of them are pretty liquid, but which one's doing better? Molson, right? Molson is more liquid because Molson has to wait about 20 days less than Anheuser does to collect its accounts receivable. So Molson is getting cash more quickly. So cash right now is better than cash tomorrow, right? So Molson proves to be a little bit more liquid than Anheuser because they're collecting their accounts receivable more quickly. Might have to do with the policies they have or how good they check the creditworthiness of their customers before extending credit to them. It could be a variety of things, but ultimately Molson is doing a better job of that. Okay, and the last one that we will do is 7.9 here. We're going to look at a notes receivable. So for this one, it says on September 1st, year one, Healthwise International acquired a 6% 9-month note receivable from Herbal Innovations, a credit customer, in settlement of a $22,000 receivable. Prepare journal entries to record the following. So for this one, what's happening is their customer never paid them the accounts receivable, so now they're converting it to a note that will bear interest and that the customer will then be legally liable to pay. Okay, so the first entry we want to do is converting that accounts receivable to a notes receivable, okay? And this is one way of dealing with customers that just don't pay. Sometimes, instead of a company just writing it off and using that allowance for doubtful accounts, if it's a material amount, or if a customer is habitual with doing that, a company will convert it to a note receivable to hold that customer accountable for that. Okay, so now we're just moving it, we're characterizing it differently. So it's no longer an accounts receivable, but a notes receivable. So to do this, we'll just debit note receivable for $22,000 and credit accounts receivable for $22,000. And again, moving it from one to the next. So that's what the initial entry would look like on September 1st when they agreed to convert it to a note. So now what we're going to do in B is we have to record now from September to December, till the end of December, there's interest that's building up on this note that the customer would then be owing, right? So we have to make that necessary adjusting entry for the end of December to show the interest that has built up. For the company, it's considered interest revenue, right? Because it's their customer that's now owing that interest. So let's figure out what that interest would be. Well, from September 1st to December 31st, how many months is that? That's considered September, October, November, December, right? So that's 4 months. So let's first look at what the overall interest is. So it's a 6% 9-month note receivable. So we're going to take that $22,000 note to multiply it by 6%. So remember, unless otherwise noted, the interest rates are in annual amounts, right? So we're going to take 6% times 22,000, and that gives us $1,320. So that's interest for a whole year. This is only a 9-month note, right? It's only a 9-month note receivable. So we want to convert that interest for a whole year of $1,320 and divide it by 12 months to figure out what that interest comes out to monthly. And again, in this class, we're only focusing on simple interest. Divide that by 12, and that comes out to $110 per month. Okay? All right, so if it's 4 months of interest that we have to record that's built up between September and December, we're going to take 4 months times the $110 a month. When we do that, we get $440 of interest. Now, since we're the ones that the interest is owed to, we're going to record this a little bit differently compared to if we were the ones that owed the money, right? So there's a couple of things involved here. So we've earned that interest, right? So anytime you earn money, it's considered revenue, but this specifically is considered to be interest revenue. So interest revenue is involved here, and what else is involved? Well, the interest is not going to be paid until the end. So this is not cash that's yet received. So if something is yet to be received, it's considered a receivable. So we'll refer to it as interest receivable. Okay, to record that, we will debit interest receivable since it's an asset. We'll debit that for $440, and we will credit interest revenue for $440. So that's that entry on December 31st to record that accumulated interest. So this would be an adjusting entry. So they could have been doing adjusting entries at the end of December, October, November, but in this case, we're just assuming we're doing one adjustment for the end of December. So that's totally fine. Now, if the note originated on September 1st, if it's a 9-month note, when's it going to mature? September, October, November, December, January, February, March, April, May. So it's going to mature at the end of May. So it says in C, the collection of the principal, record the collection of the principal and interest on May 31st. Okay, so the last time we recorded anything regarding the note, it was December 31st. So now, what would have happened between December 31st and May 31st? More interest. So how many months is that? That would be 5 months, right? So there's still 5 more months of interest that we would have to record. So 5 months times $110 a month, that's $550 of interest. Now, again, from the perspective of us, that, you know, the money is owed to the company. We don't owe the money. What would need to be recorded here? Is that is that more interest revenue? Of course it is, right? It's interest revenue. But is there any interest receivable related to this $550 involved? No, because actually on this day we're paying everything, so there's no additional interest receivable for that amount. Okay, so what's happening on December 31st? So there's interest revenue of $550 that we need to record, and we are finally receiving this interest receivable from before, right? So we have interest receivable of $440. So what's the total interest paid to us today on May 31st? That's going to be $990, right? So that's total interest that would need to be paid to us, but $550 of it is now being recorded as interest revenue, and $440 of it has already been recorded as revenue, but it was also recorded as a receivable. But then also the note itself is being paid back, or should be paid back, right? And that's $22,000. So all of this needs to be received in cash. And how much cash is that? That's going to be $22,990. So there's 4 accounts involved here. So how do we record the receipts of cash? We debit cash, right? In this case, we would debit cash for $22,990. And I'm going to credit the interest receivable account, since now I'm receiving that. It's not that interest of $440 is no longer owed to me, right? So I'm going to credit that interest receivable. I'm going to credit the note receivable, since now it's being paid. If it's being paid back, they don't owe it anymore. So I'll credit the note receivable for $22,000. And And then I also need to further record that interest revenue that refers to the last 5 months. So there's interest revenue of $550 that needs to be recorded as well with the credit. So debit cash for the total amount received, and that total amount of cash received, part of it is interest revenue for these last 5 months. Part of it is the interest receivable from the previous 4 months, and a large chunk of it is the note receivable, just the principal amount of the loan that we made to the client. Okay, so that's how we record the receipt of a note receivable and the accrual of interest revenue, and finally getting paid, getting that payment from the entity that owes you that money. All right, that's it for Chapter 7 brief exercises.